Welcome back to the Deep Dive, your essential daily briefing. And, wow, we are starting December with a serious stress test.
A big one, yeah.
If you look at the charts, you're seeing some pretty significant damage. Bitcoin has experienced a really sharp daily decline, dropping from nearly $90,400 yesterday to settling around, what, 86.3 today?
That's a big move.
That 4.5% hit in just 24 hours.
Yeah.
I mean, that felt particularly brutal.
It was a shock, but maybe only if you were focused purely on that short-term momentum. You can almost see it coming, given the market structure.
Right.
So I think our mission today is really crucial. We need to separate the short-term high volatility price pain we just saw from the really powerful structurally positive things happening at the exact same time.
And that's the duality, right?
Yeah.
That's what's so fascinating. The data points feel like they're from two different worlds. How can we have the biggest names in finance finally opening the doors while the price itself is just getting hammered?
Exactly. And we have to start with the hammer.
Okay, let's unpack this price action.
Let's do it.
So while the closing number is sitting there at 86.3, the action itself was way more volatile.
Oh, much more.
I mean, intraday lows on some exchanges actually dipped below 84,000. They touched 83,900.
And this isn't just a one-off event. You have to see it in context.
It's an extension of that broader downtrend we've been seeing since early November, when we were flirting with highs above 120,000.
A painful month, especially for anyone holding leverage.
And that leverage is the key here, isn't it? It's why the drop felt so swift and severe.
It's precisely why. This wasn't organic selling. We didn't see huge holders suddenly decide to dump. What we saw was a market flush.
A flush of what?
Over $600 million worth of leveraged crypto positions were liquidated in that short window.
Wow. $600 million.
And to give you some context, these positions were overwhelmingly long bets. So traders were betting the price would just keep going up.
And when the price starts slipping, those forced margin calls, they just cascade.
Precisely. Think of it like a crowded theater with a single tiny door. Everyone tries to get out at once, and it just crushes the price faster than if they were all selling incrementally.
It just confirms that even with all this maturity, that high volatility fueled by leverage, it's still a core feature of the asset.
It is. It's the cost of entry, really.
And what made this one feel particularly painful was the macro backdrop. This wasn't happening in a vacuum.
Not at all. It wasn't just isolated crypto drama.
The sell-off coincided perfectly with weakness across traditional U.S. equities. You had the Dow, the S&P 500, the NASDAQ all finishing lower. And at the same time, we saw bond yields creeping up again.
And that might be the most important takeaway for anyone watching from a macro perspective. It just confirms Bitcoin's transformation into a true risk-on asset.
It tracks macro stress so tightly now.
Tightly. When you get inflation concerns or, the Fed sounds a bit hawkish, bond yields go up, investors de-risk from tech stocks.
And Bitcoin suffers the same fate.
Exactly. Its integration means you have to watch the Federal Reserve's posture just as closely as you watch any on-chain data.
So tactically speaking then, where does this $86,000 price point leave us? Are we on solid ground?
Technically, we are in a pretty precarious spot. That close puts us right near a key multi-month support level.
Wow.
That's located roughly in the low to mid $80,000 range. We've seen buyers step in there consistently for months.
So the battleground is right around 80,000.
The immediate battleground is holding that $80,000 line. If sellers manage a sustained break below that, it's a huge psychological and technical threshold.
It opens up the downside.
Analysts are pretty much unified in warning that it opens the path toward deeper retracements. You could be looking at the $70,000 level again. Losing 80K would be a big shift in sentiment.
So we're battling this psychological impact of a huge drop while also fighting for a critical support level. It sounds like pure panic.
It sounds like volatility. But now we have to pivot. We have to look at the other side of that duality, the long-term structural story. Because while we were all watching that fight for $80,000, some of the final barriers to institutional capital just crumbled.
Okay, let's talk about Vanguard, because their move this week it's truly a milestone. For years, they were the wall, the firm that fundamentally rejected any Bitcoin exposure.
Their reversal is monumental. We are talking about Vanguard, a firm that manages roughly $8 trillion in assets under management, AUM.
8 trillion.
And they had this really staunch, almost ideological ban against allowing access to spot crypto ETFs, related mutual funds, anything.
And that ban is now officially over, effective this December.
Yeah.
They are allowing the trading of third-party crypto funds on their platform. So why now? Why break such a long-standing, very public position?
Well, I think there are two likely factors. First, client demand it probably overwhelmed them. When you see Fidelity and BlackRock launch these incredibly successful ETFs, Vanguard's conservative client base, especially those using retirement accounts, they start demanding equal access.
They don't want to be left out.
Nobody does. And second, and maybe more critically, it suggests a shift in what they see as their fiduciary duty. That's the legal obligation to act in their client's best interest.
Interesting.
If competitor research, like the data we're about to talk about from Bank of America, suggests a small allocation actually improves risk-adjusted returns, well, then maintaining a ban starts to look legally and competitively untenable.
That is a massive reduction in friction. I mean, this affects tens of millions of clients who traditionally use Vanguard for long-term passive investing. It feels like the last remaining distribution gate just swung open for mainstream retirement accounts.
And this transition from just flat-out rejection to cautious acceptance, it's being reinforced by Bank of America. They're not just allowing access, their wealth management division is formally endorsing it.
And the context behind their recommendation is so key, isn't it? Buffett formally recommended that high net worth clients allocate up to 4% of their portfolios to crypto.
Up to 4% for diversification.
For diversification.
And that moves Bitcoin from the realm of, speculative toy to institutional portfolio building block. The 4% ceiling is definitely a cap, reflecting the volatility, but the reasoning is solid.
Right.
BofA's own research cited Bitcoin's historically higher returns over multi-year horizons and its ability to improve the overall risk-adjusted outcomes of a balanced portfolio. This isn't advice to go gamble.
No, it's mathematical diversification advice from a famously conservative institution.
And when you combine Vanguard opening up the plumbing and BofA providing that mathematical justification, I mean, the structural tailwind is just undeniable. But then you have BlackRock, who are focused on the even longer game.
Tokenization.
Exactly. The CEO, Larry Fink, is framing the tokenization of real-world assets. So turning everything from real estate deeds to private credit into digital tokens on a blockchain. He's framing it as a fundamental next-generation financial shift. He's comparing it to the internet.
So what does that mean for Bitcoin specifically? Because, BlackRock could use any blockchain for that.
It creates a massive, massive demand for censorship-resistant, globally accessible collateral. A base asset that isn't tied to any single government or sovereign entity.
A neutral asset.
A neutral asset. If the world's financial plumbing is going to run on digital rails, it needs a neutral, immutable store of value and settlement layer to underpin the whole thing. And that reinforces the long-term thesis for Bitcoin as that foundational layer for this new tokenized economy.
Okay, so let's connect that institutional push to the regulatory side, because you need the infrastructure for that. We saw some really critical progress on stablecoins.
Yes, which are the liquidity rails, right? They connect the traditional dollar system to the crypto ecosystem.
You're talking about the Genius Act in the U.S.
Yes. The Genius Act establishes a necessary federal framework, and crucially, it requires payment stablecoins to be fully backed by high-quality liquid assets.
Like short-term U.S. treasuries.
Exactly. This is all about making stablecoins boring and reliable.
So how does demanding that high-quality collateral actually reduce uncertainty for a player like a Bank of America or a Vanguard?
It reduces counterparty risk to almost zero. When large institutions are trading, they need absolute certainty that the digital dollar they're holding is redeemable instantly for a physical dollar.
And that the assets backing it aren't just junk.
Right, that they're not some opaque commercial paper. By requiring full backing in liquid short-term government debt, the Genius Act ensures stability, reduces legal uncertainty, and it essentially formalizes the link between regulated banking and on-chain liquidity. It's trust infrastructure.
And that trust infrastructure is so vital, especially when you think about the speed at which threats are evolving. And speaking of threats, that research from Anthropic this week it's genuinely alarming. It forces a whole new way of thinking about security.
It confirms a paradigm shift in security risk. Absolutely. Anthropic researchers showed that advanced AI agents, so variants of Claude and GPT, can autonomously discover and then carry out profitable exploits on complex smart contracts.
Without human intervention.
Without human intervention.
Wow.
They identified vulnerabilities that could have been exploited for $4.6 million in profits.
So the attacker isn't a person at a keyboard anymore. It's a sophisticated, automated system running 24/7.
Exactly. Think of it like a highly sophisticated autonomous lockpicker that's working on every digital vault in the world simultaneously. And now, Bitcoin's base layer is pretty simple and resistant to these kinds of attacks.
But everything else isn't.
But this is a profound risk for Layer 2 scaling systems, for DeFi protocols, for all the programmable logic that BlackRock's tokenization vision relies on.
The cost of running these attacks is probably tiny compared to the reward.
It's negligible. And that just raises the technical bar for security to a completely unprecedented level.
So that's the technical risk. But separately, political risk seems to be mounting too. And it's focusing not on the tech, but on its distributional effects.
That's right. We're seeing this growing narrative, often from political commentators, arguing that crypto's massive windfalls, they accrue mainly to early adopters and large holders.
And that this exacerbates economic inequality instead of solving it.
And that critique is gaining traction.
So if that narrative gains political consensus, what does that lead to? More regulation.
It raises the specific risk of stricter regulation in future election cycles. You could see things targeting windfall gains through new tax policies, or maybe restricting retail access to complex crypto products, all under the guise of, consumer protection.
So it puts a political ceiling on the technological innovation.
It's a tension, a real tension between innovation and equitable distribution. But despite all these threats, AI, political, regulatory, the core physical security of the Bitcoin network itself remains incredibly strong.
Yeah, the mining sector's resilience is a fantastic counterpoint here.
It really is. Kango Inc., for example, just reported a massive 60.6% sequential jump in Q3 revenue from its Bitcoin mining business.
That's huge.
$220.9 million. That scale tells you that network security is still robust and highly incentivized. And what's more, major miners are diversifying. They're using their high-performance computing infrastructure for other lucrative workloads, like AI processing.
So they're not just securing the blockchain. They're building this dual-use infrastructure that makes them more economically resilient and maybe improves the long-term perception of what the mining sector is even for.
Precisely.
Okay, so let's circle back and apply all this structural context to the price charts, because you said the technical indicators are flashing a pretty serious warning.
They are, a signal that cannot be ignored.
You're referring to the monthly moving average convergence divergence, the MCD.
Yes. The monthly MACD has just turned negative for the first time since the deep bear market of 2022.
And for those who don't follow this, the MACD is a momentum indicator. When that faster line crosses below the slower one on a monthly chart, it signals a major loss of upward momentum.
A major loss.
So how significant is that signal historically? Does it always lead to more pain?
Historically, a monthly negative cross precedes extended periods of consolidation or just outright corrections, usually in the range of 20 to 30% or more from the local peaks.
So it's a big deal.
It tells us that the major trend that's been driving the market is fundamentally shifting, and it often requires months to reset. If historical patterns hold, this is a dire warning that the pain we felt this week could be just the beginning of a larger multi-month correction.
Aren't these classic technical indicators kind of meaningless now that you have Vanguard and Bank of America and BlackRock involved? This is where that grayscale counter-thesis comes in.
That is the core of the debate.
They argue that institutional adoption just invalidates these old patterns.
That's their whole argument. Grayscale's research says Bitcoin is, in fact, breaking that rigid, historical, 4-year halving cycle pattern. They contend that the sheer weight of institutional capital, from the ETFs, corporate holdings, wealth management, it all acts as a powerful smoothing mechanism.
So instead of that sharp, predictable boom-bust cycle that's tied to the halving,
right,
the institutional flow provides consistent demand, which extends and maybe even flattens the whole cycle.
Exactly. They're projecting that instead of collapsing into a traditional bear market, this structural demand will just accelerate the recovery, making new all-time highs more likely in 2026, bypassing that whole extended consolidation period that an indicator like the MACD would predict.
It's institutionally driven efficiency replacing speculative mania.
That's the thesis.
So what does this all mean for the person trying to allocate capital today? You've got a flashing red technical warning telling you to brace for a 20% drop, but it's overlaid with this monumental institutional flow telling you the floor is higher than it's ever been.
It means you have to separate your time horizons. Bitcoin is still a high volatility asset where double-digit swings are entirely normal. That nearly $40,000 drawdown from the November high confirms that tactical downside risk is substantial.
And that macro monitoring is essential.
It's essential for any short-term decision-making. You have to watch the Fed. You have to watch bond yields.
So the lesson from this week's duality, then, is that the price is still very sensitive, but the underlying structure is fundamentally changing.
Precisely. The structural tailwinds from Vanguard and BOFA support multi-year demand. They provide a new, durable floor that just did not exist in previous cycles. This recent drop reinforces the requirement for Bitcoin to be treated not as some isolated asset, but as an integrated component of a sophisticated, macro-driven strategy.
The market is maturing, even if the price action is still wild. And that integration requires institutional trust. And trust relies fundamentally on security. So we've talked about Vanguard opening the gates, BOFA giving the rationale, BlackRock building the tokenization future, all while the Genius Act clarifies the rules.
But the threat landscape is evolving faster than the regulation. That Anthropic research confirmed that autonomous, sophisticated AI threats are technically feasible and highly profitable against these crypto systems.
So institutional adoption is going to rely on the ecosystem's ability to defend itself.
It will. The ultimate success of this entire structural shift, from traditional banking to the tokenized future, it may all hinge on this one single factor. So the question you need to mull over is this: can the entire crypto ecosystem out-innovate and defend against this new wave of AI-driven security risks that we now know are real? This structural security race may well be the defining factor for mainstream institutional trust over the next few years.